Well, it's interesting. I stand up here, and this is the first time I've spoken in front of anybody with the masks, and I was going to say it's good to see a bunch of familiar faces, but instead I'll just say it's good to see a bunch of familiar eyes, and hopefully that works, you know. But following these two gentlemen and how they spoke and they presented and all that, I could easily say ditto and walk off, and that'd be the end of the presentation. But as I reviewed my slides this morning before I came up here, there's kind of this underlying theme on this whole thing that everybody's, and when Paul called and said, hey, you know, what now? We've had COVID, now what? And as I look at all my slides, I'm thinking it's very easy for everybody to get very myopic in the next 6 months. What's gonna happen? What's going on? And as I look at the slides and see the trends and the research and all that stuff, everybody in the room here kind of was selective for this presentation because everybody has bought and sold. You guys have been active. You guys are kind of ensconced in multifamily DFW real estate. You want to have that a little more chin up, kind of horizon looking kind of concept, because like Jacob said, we could be in Cleveland, we could be in Cincinnati, we can be in Oklahoma City, we can be in, you know, anywhere else pretty much in the country, even Manhattan in the 5 boroughs. But we're in Dallas-Fort Worth, and for however you got here, it's good you're here versus somewhere else. So it's just, as I go through my slides, be thinking that in the back of your head. I wanted to start out kind of high level and then get pretty myopic into Dallas-Fort Worth and certain submarkets, but you know, there's still this underlying theme of going forward where we're always going to have renters, and I think that's even increasing just because you've got younger folks that are delaying marriage and families. You've got empty nesters that are moving back into rental properties. And a lot more people just like the flexibility. And I struck out the third one there because this was a presentation that I gave on March 10th in San Jose, California, this slide. And I showed up and it was very similar to this. And I was out there with my family for spring break, and I said, well, let me go down there. I'll give a presentation to some investors down there in Silicon Valley. So I show up, and that is the day that Google announced pretty much at 11 o'clock in the morning, all their 20,000 employees, please go home, COVID is rampant, start working from home. And so that kind of rippled throughout all of Silicon Valley, and there were supposed to be 60 people in the audience that day, and it ended up being like 15. So the room was, you know, just a couple of people in this huge room, but I wanted that slide to be on there because the urban living concept is really in question as we go forward here now. What is that? I think Nick relayed to that. The other point I wanted to point out was over the past, you know, years, student debt has just gone through the roof. The average amount of student debt now is $35,000 that a student is graduating with. So for him to rent an apartment and go, let me go buy a house and move out, everything is just being delayed. And it's like 2/3 of the students that are graduating have some sort of student debt. So that does weigh heavy on decisions going forward in your 20s. So now we get into more of Texas. And this was I saw this and I said, well, let me put that up there. And it's kind of hard to see, but you guys, you know, we've got Texas, but then they've renamed all the other states. And I was actually going up to Colorado a couple weeks ago, and I saw somebody from Texas, and this is on a t-shirt, so this is not me saying this, but it said the United States equals Texas and it's 49 bitches. and so this is a good segue into how we look at Texas and in regards to rental growth and everything else. This is all from 2019, but I wanted to point this out, that of all the investments, $24 billion in the US in multifamily was invested in Texas in the 4 major metros. So you're looking at 24 billion went into that. That equals 14% of the entire United States investing in multifamily was in Texas. If you look at that a different way, every unit that sold, one of those in 6 was in the 4 major metros. So that's including Miami, LA, everything else. 1 in 6, roughly 14 to 18%, was in the 4 major metros. So, I mean, having that type of language and attraction on a national level, everybody is now focusing on Texas. So, and then if you break that down even more, and the slide's messing up a little bit, but it shows the amount of the 24 billion broken out by the 4 major metros. This big square is Dallas-Fort Worth, 10.5 billion. So it's about 41% of everybody investing in the 4 major metros are investing in Dallas-Fort Worth. So it's, and I think that's the highest number of any particular metro in the entire nation that people are investing. So then we even get a little more myopic. So this is pretty current research until June, getting into the pre-COVID, post-COVID environment. What we're looking at is how the decline, it obviously spiked and then has trickled down. But you see Austin, DFW, San Antonio, and Houston have all significantly lower unemployment rates than the rest of the nation on average. And it's declining. And the strongest one is Dallas-Fort Worth. So then how do we go forward from here? This is an analysis of, I think, 42 of the largest major metros, and I tried to make the 4 major metros in Texas larger so you can see it. But the question is, how quick are we going to recover from this? And in regards to that job growth, that what everybody relies on in regards to employment, as well as filling up the apartment units, beds and heads on beds, is Dallas and Austin are pretty much right there at a year and a half. Yeah, that sounds like a long time, 18 months, but if you're staring at, I mentioned Cleveland earlier, Chicago, Philadelphia, I mean, they're almost 4 years before they're going to recover in the type of job growth that they're going for. So it looks ugly and bad, but we're in the location that is ideal to be investing in multifamily going forward. And I also want to just point this out. So from 2008 to 2018, how have we seen, I know it's a little historical, but I've got future graphs that show this. We've seen a consistent population growth throughout Texas of 3.6 million in the 4 major metros up till that time. But then if you project it out, let's keep our chins up and let's look at what we're investing in. Obviously, it's not right now in the next 6 months, but going forward over the next 12 years, you're looking at another 1.4 million people in DFW. That on average is about 1.5% population growth for the next 12 years. So then we just dig in a little bit into the growth rate, the overall growth rate. And if you look on that, Dallas is number 3 for the people in the back. And Dallas is by far the number 1 population growth going forward. And this is in the next 12 months, year over year. It's a little dated. So this is like middle of 2019 to 2020. So this does not take into COVID, but hang on, there's more slides. So you're seeing, a substantial amount of growth compared to all these other ones. But then the next 5 years, going from 2018 to 2030, they're projecting on average about 700,000 people moving here. So, and that is by far the fastest and the largest list. Houston's number 2, and then you go into the larger metros of Phoenix and New York. But again, we're looking, chin up kind of projections of how are we going to do this if we want to invest for the future. We're in the right spot going forward. I'm probably a little opinionated, but I honestly think in regards to investing in multifamily, for the past 10, 20 years, and you're going to be doing it for the next 10 or 20 years, what we're witnessing here is literally just, in my opinion, a speed bump on the road to success. Just little old me. The other drivers that people are studying like this is when you see major corporate relocations coming here. You've got Charles Schwab up in Richardson, Uber. They're in the Epic, they're in Deep Ellum. They're bringing they call it Uber HQ2. They're bringing 3,000 employees in the next 3 years, each one making about $100,000. So this is not your entry level kind of stuff. This is mid-level corporate, white collar, college educated folks that are relocating here. And then you've got the PGA headquarters all the way up there, almost at 380 and the toll road being developed. They're moving here from Florida. So you're seeing still a lot of long-term attention for development and growth in this area. So now if a little more projection going forward, this is the end of June's analysis for second quarter 2020, and it's categorized just by the name of the city. So Austin is not technically in third place, but it starts with an A. But you can see I've bolded them up, but you're seeing the projections, and this would be end of June 2020 through June of 2021. Let's just marry Dallas and Fort Worth together. You're looking at 26,000 units coming online, and the absorption rate is going to be around 18. So it's going to be a little soft going forward, which you can see all the way to the right that your rent growth is going to be a little bit challenging for the next 12 months. They're showing it as being a little more of a negative. But again, if you look forward for the next 5 years, and this is organized by number of units coming online. So you got 3 of the major metros in Texas in the top 5. But that looks kind of scary. It's like, okay, that's a lot of units coming online. But if you start to go to the right, you see under vacancy, our vacancies are, let's call it 5 and 6%, but the impact, except Houston, I think a lot has to do with the price per barrel and that kind of stuff. You're not seeing much of an impact on the vacancy, even with this growth that's coming in. And then all the way to the right, you're seeing the same store rent growth still in the 2s for the next 5 years. So, and this is the end of June. So this is taking into the impacts from COVID. So I want to just show the scattergram. So this is digging even deeper into it. So these are submarkets just for Dallas-Fort Worth. So where you want to be is in the upper left-hand corner. Positive rent growth, decreasing vacancy. Lower right is not where you want to be. Vacancy increasing and rent declining. So you look at most of us in here, I think all of us in here are more BC investors, developers, value-add type of folks, and you're looking at a lot of that space that I think we all look at if a deal comes on the market: Mesquite, Grand Prairie, North Arlington, those kind of areas. Then in the lower right, those are a little more of the flashy kind of shiny object kind of deals that we've been looking at for the past 4 or 5 years. Uptown, the medical district near Parkland, downtown Fort Worth, Oak Lawn, Park Cities, that kind of very infill location that everybody wants to be around, where the developers are developing, but you're seeing that's also the highest density of folks too. So I think the COVID is having an impact on hey, where do I want to live? And I think a lot of people are looking towards the suburbs a little more. So just like Jacob did, I wanted to give one case study in regards to the signed CAs and the level of interest of buyers. And what we're seeing since COVID is that when we put a deal out on the market, let's say it's a B asset, or let's say it's a C asset, we're used to having C investors look at it. Well, since COVID, now we're seeing B and C investors look at a C asset. It seems like everybody's box has just gotten bigger. So if somebody that's traditionally been buying Class A kind of product, 2000s and newer, all of a sudden they're looking at the 80s vintage stuff, even tax credit stuff, even deals in marginal neighborhoods. You can tell they're really exploring, hey, I've got all this pent up money that Nick and Jacob have mentioned, and the amount of capital chasing the deals is significant, but they've got to place that capital. And what we're witnessing also is you have that conversation where, hey, I've got this fund, I'm looking for normal IRRs, cap rates, cash on cash, kind of that type of thing. But then you also have these folks that when COVID hit, they would create a vulture fund. And they would think, okay, this is 2008, this is 2009, I am teed up, I'm ready to go in and buy stuff at 60 cents on the dollar. Well, that never happened. So all of a sudden they still have this vulture fund with millions and millions of dollars in there, and now they're all putting it into one fund and go, okay, well, we got to place the money. So all of a sudden you have this big, large capital chasing fewer deals that are on, well, I'm getting ahead of myself. So I want to just point out kind of the pre-COVID and post-COVID. This is 2 different 2-packs that we had on the market, both out in the suburbs, 80s vintage, over 200 units combined. It was very similar. One was pre-COVID. And we marketed it, and we got it awarded, and then COVID hit, the deal fell apart, and all that kind of stuff. So that was, kind of your normal in-the-box type of purchaser looking at that deal, and we averaged 3 signed CAs a day. And this is not completely scientific, but I'm a broker, not a scientist, so work with me. And then the post-COVID, this was a deal we launched, not the same set of deals, but 2-story garden-style walk-up. It was in the suburbs, same resident profile, same rent per foot area. The level of interest on that was almost double. We had just under 6 signed CAs a day while we were marketing that asset. And if you look at that list of who signed the CAs, it's very much not just your typical B-class buyer, but you had A and C product buyers looking at these deals. And you can really see the impact of it. The amount of phone calls, the amount of emails that we receive is significant. So not really in conclusion, but I wanted to make just some key points here. Most of the deals we're seeing, the T12 that we're analyzing, you're seeing recently the T12 kind of dipping. So the T1 is not as strong annualized as if you annualize the T12. But what has impacted that and driven, I think, motivated a lot of buyers is that darn low interest rate. I mean, that is historically low. And like Jacob said, if we're at 3% and the green program has all of a sudden, popped its head up again and everybody's chasing that thing, and you can really get sub-3 IO interest rates. That's great opportunities. So what that is doing a little bit when people are still looking at the same cash on cash, hey, I need an 8% cash on cash year one, they're looking at the cash on cash. So as long as their debt service is less, they can still achieve that. So even though we've had lower NOIs, the cap rates you haven't seen that COVID correction or adjustment or impact. Like I mentioned earlier, large amounts of equity in the market. It's the most, I'm doing this 20 years, this is probably the most amount of money that I've seen chasing deals. Deals on the market. So at least in our shop, a lot of deals are getting off market, and not like the old way of, I got this deal off market, whisper, hush, hush, let's see if we can do a deal. It's more, you have a seller that his NOI is not as strong as it was, let's say, in January or February. He's nervous about putting it on the market because of liability. If we do showings, somebody gets COVID, yada, yada, how are we going to handle that? Goes under contract, how do we handle showings that way with inspectors and third parties? So there's a lot of that going on. So the conversations are like, hey, yeah, we would like to put it on the market for whatever reason, but right now, for us internally as a seller, it's not the right time. But go talk to 20 people or 30 people that would take a hard look at it, sign a CA, underwrite the numbers, and make an offer. So we've seen a lot of that going on in the A, B, and C product, and deals are still getting done that way. And just like Jacob and Nick had mentioned, we just haven't seen that COVID correction, and it hasn't come. And I think a lot of people early on were surprised that their rents and their occupancies and collections held up in April and May. And then I've got to put my caveat on there. We could still see a COVID resurgence, and like Jacob said and Nick said, there's an election coming, and the way Washington D.C. works, the stimulus package, are we going to see payroll adjustments? Are we going to see, some sort of weekly, just automatic $300, $400, $600 a week check being mailed to people that make less than $100,000? Are we still going to see that? What's going to happen after the election? Nobody's trying to get reelected right then. That all could dry up or it continues. So there's still a lot of uncertainty, but that's my story, and hopefully it's been informative.